My name's Sam Marsh. I'm a mathematician at the University of Sheffield. I'm also an elected negotiator over USS for the Union UCU. And I'm going to give now an update of a presentation I first gave in 2017, which I'm calling a reality check for USS. Now, what this is going to do is look at investment returns that have been achieved by the fund and compare them to forecasts that were made in subsequent or successive valuations. Now, I'm calling it a reality check, or perhaps I could have called it a sanity check, because really what we're going to do here is look at how the numbers that come out of a model, namely USS's FBB model, their fundamental building blocks model, which is their way of forecasting investments, how they look compared to a sort of a view of reality when you take a step back. Reason being that the FBB model that USS uses for their investment returns is opaque. You can't see the workings. So in other words, you just have to trust the numbers it produces. And you should never trust the output from a mathematical model without being sure it's giving you something sensible. Okay, with that said, let's crack on and start off by looking at a 10 or 11 year period from 2001 to 2011. I'm stopping there for the moment, but we'll get successively further forward in time. So this was this is a graph showing how the assets performed over that time period based on annualized returns from the USS annual reports. And what you can see, there are a couple of features that I pointed out last time I gave this talk. For example, this is the 2008 crash with a subsequent dip and then a slight bouncing back to 2011. This one here was the dot-com bubble that burst. But yeah, so you see a pattern here of some growth, but two big bubbles that burst. And the key point is that in 2011, this was the first valuation at which there were big problems signalled for the fund, or at least that's what the valuation said, because essentially this growth that looked pretty solid over the mid-noughties collapsed and things were looking pretty shaky. Okay, now let's just look at what happened at the 2011 valuation. Well, there was a forecast for the asset growth, and it looks it looks kind of sensible on this scale, that's what the assets might do over the subsequent 3 years. Let's compare. Of course, we have the benefit of hindsight now, and compare with what actually happened, which was that. And you can see actually that's not a bad match for the forecasts in 2011. Okay, so let's move on and see what happened next. So I'll move that graph down a little bit. And let's carry on that forecast up until 2018. And of course, in 2014, 3 years later, there was another valuation. And that's where the assets had got to by the valuation date in 2014. That's the solid line. So what was the forecast at that point? Well, it looked like this. And as I remarked last time I did this presentation, it looks something like the forecast reverts back to the previous one, which arguably isn't necessarily the wrong thing to do. But yes, we'll look in more depth at that as we go on. But that was the forecast. Key point is, of course, to compare that to reality. And what actually happened from 2014 through to 2018? Well, that was this. Okay, so that forecast missed the mark considerably there. Much stronger growth was achieved than that forecast in the valuation. Of course, let me just remind you that in 2011, the forecast there was the death knell for final salary for new entrants. Because of that forecast in 2011, that's the this lower dotted line here, that was the forecast that essentially said that final salary wasn't affordable. In 2014, for new entrants, although it did continue for those already in the scheme, in 2014, this one closed final salary for good and introduced the career average scheme for all. Okay, so let's move on and take those forecasts further forward. And one interesting feature you can see here is that these lines start to cross. So the forecast from 2014 starts to cross over with the forecast from 2011 to around 2021. And essentially, if you extrapolate these further, which we will do later on, you'll find that the 2014 forecast ends up a lot lower than the 2011 forecast. And essentially that was the reason why a new deficit had emerged. Okay. Right, so now 28. I paused at 2018 with the actual asset growth there, and that's because there was a valuation in 2018. In fact, there was a valuation in 2017 as well. Don't forget, that was the one that kicked off all the industrial unrest. So let's put on those two forecasts, and you can see what those lines are doing here. Oh, one thing I should say. Sorry, these numbers are all adjusted for inflation. These are real terms numbers. So I've adjusted for inflation in all the forecasts and the achieved returns as well. Okay, so the lower dotted line here, this was the forecast using the 2017 valuation. That was the one that the employers responded to by saying that they wanted to move to defined contribution. And of course, there was the big dispute over whether that valuation had any relevance to reality in it. The joint expert panel, of course, reported on it and, roughly speaking, came down somewhere close to UCU's position. 2018 was a revised valuation that USS undertook because they said that was the best way to take into account the joint expert panel's recommendations. And on the forecast you see here, it looks like there's a very slight moderation in the approach they're taking there. In other words, a slightly improved forecast. But again, there's a question mark here over whether these are sensible. These lines seem to be attempting to get back to where the old lines were. But again, we'll look more closely at where they end up. But of course, we have hindsight now, and we can compare those forecasts with what actually happened between 2018 and today, which is that. Okay, now, some features here. This dip is the impact of coronavirus. That was the hit from the pandemic back in March. And this subsequent growth has been the rally since March. Okay, now again, you're probably noticing a pattern. We've diverged from those forecasts. Right, okay. So we're at 2020 and of course, 2021 we are in now, apologies. There's a valuation as at March 2020. We don't know what forecasts USS are going to use there. They did put some forecasts in a draft document that were pretty pessimistic. The worst case, they said all they could forecast would be flat growth, CPI plus 0. That's no growth above inflation for the rest of the life of the fund. In other words, the line would just go completely horizontally from 2020 and across. I haven't put those forecasts onto this graph because they're not finalised yet. But one thing that I thought I could put on was the most recent, what USS call FBB figures. So these were from November last year, November 2020, and they're the most recent figures that have been published on the value of the assets, which was way up at 78.8 billion, and the forecast investments that USS were basing their deficit calculations at that point on. And in fact, let me just show you something that was written in a note from Bill Galvin, Chief Executive of USS, to institutions across the country. This went to all Vice-Chancellors as part of a bigger update. And the first paragraph there says, "The passing of time since the valuation date has not mitigated the challenges we face. The funding position has, if anything, deteriorated since the 31st of March 2020 and is now even more pressing. Financial markets continue to signal that investment returns are likely to be lower in the future than we expected in the past." Okay, let's just go back to this slide. So the bottom of this dip was March 2020, and this is the passage of time since the valuation date. Okay, that's the thing that Bill is saying is causing increased pressure since we've moved from the valuation date. He does go on to say that there has been growth in the assets to November, and in fact the figure that's on that graph is November 2020. By the end of November 2020, the future service costs and deficit were up significantly. So look at this deficit, 23.9 billion from a 3.6 billion one in 2018 is what he's saying. And here's the asset value that corresponds to this point on the graph. Okay, so the net effect, says Bill, is that a recent recovery in asset values has been offset by a poorer outlook for expected future investment returns. And this is the kind of writing that you would is constructed, I think, to make people nod along and say, yeah, absolutely, I see the point. There's been a pandemic, there's been economic harm done by the pandemic, lower future investment returns. I can see that even if there's been some growth in assets, perhaps that's a bubble, and in any case, we're going to be a less prosperous country going forward. So let's just have a look at what those lower investment returns look like that Bill was talking about, that made that 23.9 billion deficit by November of last year, and they look like that. Okay. So, in other words, this trend is very much finished, and the line is going down from here. That's a growth of minus 0.69% per year in real terms. In other words, the best USS think they can do or are prepared to allow for is losing 0.7% of the value of the fund in real terms each year. Right. Now, I think it's quite useful to zoom out on this graph and have a look at where these lines end up, because it's really quite striking. So, apologies for that jolt there. Here's the solid line that we had previously going up to this point in November 2020. Here were these lower investment returns that Bill says are now forecast. And you can see why a massive deficit would have opened up on the basis of those investment returns, because this line just plummets down, down, down. The line that climbs highest, of course, was the one back in 2011. That was the point at which USS said that the final salary scheme should end for new joiners, but that career average would sort it out for new entrants. And you can see these other forecasts. Well, there's a matching to some extent. 2014 and 2018 actually are relatively similar outlooks in the big picture in some sense, although of course we had much more in the way of assets in 2018. Well, anyway, contentious point. 2017 is one that stands out as well here. But look at these lower returns that Bill is forecasting at this point. Well, I'd say Bill is referring to, these are the forecasts that come from the FBB model. So the real question is this a sensible forecast? Does this make any sense compared to historical growth, compared to previous valuations as well? And the other thing that I think is worth pointing out here is we've had 10 years here of forecasts from USS starting in 2011 and ending up at 2021-ish, and the growth has exceeded quite significantly the forecasts in every case. And each time the growth has exceeded the forecasts, USS have responded by downgrading those forecasts, and in some cases severely. Okay. Now, let me just finish on one more point. This is what the scheme looked like in 2008. So this is 2001 to 2008. Apologies for, well, I guess this title isn't misleading because my axis goes as far as 2021. But this is 2008 and where we were at that point. And of course, there was a valuation then. This was just before the crash, or rather, the crash hadn't affected the assets. But by the time the valuation was filed, it was known that there was some economic turmoil going on. Anyway, the valuation was finalised with that forecast for asset growth. Okay. Now, of course, we know that what followed was a big crash in asset values, followed by some kind of recovery. But the interesting thing is comparing from 2008 all the way through to 2021 and seeing where we end up, and you find we've exceeded the forecasts that were made in 2008. Now, on this valuation, with these forecasts, it was deemed final salary was sustainable, and the contribution rate that would sustain it was 26% of salary joint. The fact that we've exceeded those forecasts since 2008 over the timescale we're looking at here says that the growth in the fund has been adequate to fund a final salary pension as it was back in 2008, no problems. And in fact, other people have written about this. Mike Otsuka has done a good comparison of the achieved returns on USS's fund compared to forecasts back in 1997, I think it was, or 1996, and shown that actually the valuations there, which showed the scheme in surplus, were based on forecasts that have been exceeded to this point. So I think that's where I'm going to leave it. Now, this is obviously a live issue, a contentious issue. There's been some other really good writing on this. Woon Wong, a fellow negotiator of mine, has looked at break-even rates, break-even discount rates. Those are the rates of return you need for there to be no deficit, and shows how they've plummeted over the previous decade or so. In fact, even less than that, but they're getting lower and lower, the rates that are needed to fund this scheme, because the asset growth continues to exceed the pessimistic valuation. So the claim that the scheme is heading into deeper and deeper crisis looks a little bit tenuous. Today, as I'm recording this, Con Keating has written a blog which makes a really good case as well for these the crisis being based on very low investment forecasts, which compared to history look very, very prudent. Okay, I will leave it there. We don't know where this valuation will end up, but I hope that this will do something to move the conversation forward.